Good morning. Good morning, America. Thank you for watching Taxes Made Easy. I'm live or on rebroadcast, and it's Friday. So, on a Friday, we've got a lot to cover here. And again, we're going to take something a little bit easier, but it is a bit scary. We're going to talk about filing enforcements by the IRS and states. So if you don't file your returns, they can come in and file what's called a substitute for return, or the states call it a filing enforcement. So this is not good news, but it's something to understand how to fix this issue once it's happened. So again, got a lot of great a lot of economic news that I think is important and will help you and your family to understand what's going on with our economy. Um, and stay tuned. And thank you for watching here on a lovely Friday. And looking forward to a wonderful weekend. Welcome back, everybody. And we're going to start with an interesting story. And this one is from Fox 43. And it's kind of surprised me, which is why I wanted to share this story. Um, and it's not, the main reason it surprised me is because he only owes $107,000. But he's being convicted of tax evasion. So in IRS numbers, 107,000 is not that much. It's not that much money. Now, it might sound like a lot to most people, but why is this guy being convicted of tax evasion? And the key is in the details, and there's not a lot of details in this case. So a federal jury convicted him, so these are federal tax evasions. He's going to a federal prison. Um, and then again, they had a 4-day trial on this. So basically what he did, he filed his returns. He owed $82,000 in personal taxes, $24,000 in payroll taxes, which really isn't that much. We deal with cases like that all the time. So when I read this article, I just thought, well, how did this end up with this guy going to prison? This is how. When the IRS attempted to collect the taxes, so it's this paragraph right here, and it's hard to read when I highlight it. He engaged in a multi-year scheme. So if you're engaged in a scheme to try to hide assets, that's called tax evasion. He owes the taxes, but he's trying to evade the taxes by hiding the assets in other bank accounts, nominee bank accounts, structuring real estate deals to conceal the transactions from the IRS, false financial disclosure forms, and that did not fully disclose his bank account. So this is all information that we submit, and we've talked about at length on the 433A. You sign those under penalty of perjury. Now, is it typical for something to be forgotten or left off, or oopsie, I forgot about that? Yeah, that happens. People aren't perfect. Putting these together is not perfect science or whatever. It happens. But the question is, do you go oopsie and forget it, and then once it's brought to your attention, you bring it up? Absolutely. So this is the problem, and this is why this is why he's going to prison. When he owed the taxes, when they went to a tax and to play, instead of being upfront and honest and doing his best to set this up in a way that's favorable to him. But if he has to pay, he has to pay. He hid assets, played all these games, and that's what burns people. So I had a similar case where someone, and I mentioned this before, they tried to hide their assets. They had a home, a rental home that they had purchased. They tried to put it in a trust. That wasn't done the best way. They didn't regard the trust correctly. They didn't file tax returns. They didn't do all kinds of things correctly. And so the IRS rightly disregarded the trust. And instead of producing the documents, producing the information, they refused for months. And when it got to the point where they were not listening to me, they started getting summons to appear. And they blew off the first summons, and the second one was coming. I'm like, look, you're facing criminal penalties. That's not what I handle. You have to hire a white-collar attorney to handle this. And if it's obvious enough, blatant enough, you can go to jail. Now, in the news, we normally hear about Spike Lee or some of the other very, very famous ones that try to fought taxes and didn't want to pay. But again, only 107,000. That's one of the lowest numbers I've heard of, but it's very real. So don't play around with the IRS. Especially when you get up to the revenue officers or managers, they've seen most of the games. They've played most of the stuff. And so, again, they've dealt with thousands of cases. So going with that, and I've seen this too many times, if someone comes up with this harebrained scheme, we're going to hide your assets. We're going to set you up where you run your business completely free from paying taxes. If it sounds bogus, it probably is. If you don't want to pay taxes, vote. Change the policies of the government at the state or federal level, which again is not easy to do, but that's your recourse. Your recourse isn't let's go hide assets. That's called tax evasion. And if you fail to report, it's called tax fraud. So you do not want to ever be found guilty of either one of those, because then all bets are off. Like I said, any penalties, and he's still going to have to pay the taxes, but now it's going to be 40 years and lots of penalties piled on, and he's going to go to prison. It's going to be a giant mess for this guy. So there's no winning here. As far as, so the IRS, I want to talk about quickly their last Dirty Dozen. They've talked about a dozen different tax schemes, and this goes right along with what the article I just shared. They talk about some pretty arcane ways to avoid taxes. So syndicated conservation easements, I'm not even going to go into that, but these are things that are being put out there saying, hey, do this and you'll pay no taxes. Excuse me. If it sounds too good to be true, it's probably because it is. It's not true. Micro-captive insurance arrangements, schemes involving international elements, including foreign assets, and they focus on this Maltese retirement arrangements or misusing the Maltese tax scheme. So the IRS is all over foreign assets. If you do have assets overseas, there are criminal penalties, which can involve jail time. And yes, they do put people in jail for hiding assets overseas. There's treaties with, it's over 100 countries now where most of those assets are being disclosed to the U.S. government. And if they find you, the minimum penalty is 50% of the asset. And if you fight them on it, they'll probably put you in jail or prison. So don't play around with this. And then one of the other things that they have on here is digital assets. So virtual currency, cryptocurrency, stable coins, non-fungible tokens, NFTs. So where there's money, the IRS is going to follow. And the IRS gets reports on pretty much any legitimate virtual currency, cryptocurrency, anything like that. So any investments in Bitcoin, any of them, they're reporting this income if they're legitimate. If they're not legitimate, they're probably going to rip you off anyway. And I've seen that happen. And I had someone ask me, well, what if I found someone that's not reporting? I'm like, I'm sure you can find something in Asia. There's plenty of people out there that will take your money. Good luck ever getting a penny back. If it's not reported, it's not legitimate. Why? And again, I've seen it happen to clients already. So if you're that hard up to hide money from Uncle Sam, put it in cash, put it in a safety deposit box or something, but it's not going to gain money that way. I mean, you can invest in gold or other assets. There's ways to do it that it's not, well, you're not hiding assets, but you're purchasing actual items of value rather than doing that. One of the things I mentioned the other day was art. People are trying to play fancy games with art. The IRS has, this is such an old trick. They have an entire division that values art. And people will purchase low and then overvalue it for a sale or something like that. And they're wise to that game. So again, I've sat there and listened to entire lectures about it. So just word to the wise, if it sounds too good to be true, you're probably going to get burned by it. You might get away in the short term with it, but again, the IRS does audits, they do exams, and whenever you're reporting stuff like that that's known to be used for fraudulent purposes, it's that much more likely that you're going to get flagged and you're going to get audited, and it's not going to be pretty. So again, I don't play that game. I don't encourage people to try to play that game because it doesn't help you in the long run. My whole goal is to help people understand what they need to do to sleep easy at night. Now, I'm probably going to take a little bit more time than normal. Got a couple articles really going into the economy. And these are from the Epic Times, which tends to be a little more alarmist. But it's good information to know, because the problem is when there's a lot of bad information, especially in an election year. Everybody has their spin, so I'm going to try to ignore the politics of this, but focus on what's actually happening in the economy and how this can help you understand what's going on. So this is the Epic Times March report. The recession is in full time. The recession in full-time jobs is here. So we just had a bad CPI number. So ongoing inflation is up, and they had a good jobs report. So how come they have conflicting numbers like this? It's because our government, and it's both parties, it's not just one party, loves to distort numbers. So in March, they came out and said, hey, we created 303,000 jobs. But they look at both part-time and full-time jobs. The problem is a good percentage of these jobs are part-time jobs. So if you look at the number of employed persons, that makes a big difference. So people are losing full-time jobs and picking up part-time jobs to make up the difference. So again, it's just a different way to look at the same numbers. So this starts in 2021, January 2021, goes all the way to March of 2024. So the last 3 years. So again, the recovery coming out of COVID, jobs are going up. But then here, especially as you go, usually it's through December, that part-time jobs kind of explode through the holiday season, and then they drop off. So we had some growth, but then it's kind of stagnated since about the last year. Real jobs went up a little bit and then came right back down. And so here, this is the concern, is that full-time jobs, considered good jobs, have really stagnated, whereas the number of jobs have gone up dramatically. A $3.5 million gap in jobs here, and that is what makes a huge difference in the economy. I mean, part-time jobs, they say that overall they've lost about same period they've lost real jobs. Total jobs increases 1.7 million. However, when you look at the numbers, in the last month, 691,000 jobs were part-time, and there was an actual decrease in real and full-time employment. So that's, again, the yellow bar is full-time jobs. The darker bar is part-time jobs. And in the last period, you can see that full-time jobs, especially here, part-time jobs skyrocketed, whereas full-time jobs, it took a huge hit, and they've been negative the last few quarters. These are quarters here. That does not bode well for an economy. It's a huge problem. Again, this is another way of looking at recessions and when this has happened. Employed usually work full-time. When you have full-time jobs drop, it's a huge indicator of a recession. So again, I don't want to get too nerdy on this. Again, this is another way of showing the red is a full part-time jobs, and then it drops into a recession. As the part-time jobs increase, the reason why is businesses, if they need to cut back on costs, it's much easier to cut back on part-time jobs than full-time jobs. So here you had an increase, didn't drop into a recession, but now we're heading into another increase where part-time jobs, or I'm sorry, this is government employment instead of part-time jobs. Government employment increasing dramatically, whereas private employment is not, as a percentage, is actually suffering. So again, it's easy to see what's happening on the economy when you look at the numbers underneath it. So it's frustrating because they have all these issues here. You know what? I just went right through a break. So, summary of the previous article. I'm going to just kind of go through this real quick. I get too involved in this because it's important to understand that basically what they're showing here is every time you have a drop in full-time jobs, it usually leads to a recession. When it goes negative, it creates a problem, and that's where we have a recession. This is by quarter over the years from 1970 to current. Now, again, whenever you have more government jobs being created than private sector jobs, that's a problem as well, because we're spending more money on government positions rather than real economic growth. So I recommend you read this article, go through it. The links will be connected to our show when we post it on our YouTube channel. Lastly, want to share this last article talking about reflation. Now, this is something I've talked about, and it's really talking about the cost of money and the fact that we like to spend too much money and how it affects it. So it's not just, it's been over the last 15 years, I would argue even longer. The Bush administration really started this cheap money idea where they would have the Fed artificially keep interest rates low. But this is from January 2021. You can see inflation has shot up like crazy, and it's dropped relatively, and now it's still at 3%. They want it down to around 2% or lower. Now, is that reasonable? And then this might look like, and this is just the CPI, this Consumer Price Index, where they ignore housing, they ignore the cost of energy, which is much higher, health insurance, and then they completely ignore the cost of borrowing, the cost of money, which is shot up like crazy. So this is not a full picture, but this is one way to measure inflation, and it's still high relatively. I mean, but this again, over this period, it's estimated that we've had 20 to 30% inflation for the last few years. And that number is still going up because we're still facing high inflation. Now, a little bit of inflation is normal and typical in an economy. But when you have 3% inflation every quarter, that's 9 to 10% a year, if not more. And so that's the problem, is when you have this very high problem. When inflation, it creates a lot of issues. So this is where they look at average inflation. So it went up in the 60s, dropped in mid 70s, then it shot up like crazy. It's like every time we have a period of cheap inflation, and they're showing that every time the Fed cut rates, it lowered inflation for a little bit, but well, every time the Fed cuts rates and they artificially hold the Fed rate lower, it leads to increased borrowing and then a lot more money flowing out the door. And so their whole argument here in this article is that the Fed is half the problem. By manipulating the numbers and creating cheap money, they're manipulating the market and causing more problems than good. There are arguments, and I'm not sure I would go this far, to abolishing the Fed because it's one of they use a little lever to try to control the whole economy. The problem is there's always a reaction. And again, this, like I said, the article states it went back the last 15 years, which was Obama 2008-9 crash. Bush started before Obama. And so again, this has been Republican and Democrats both playing with the numbers, kind of pushing, creating false bubbles here. People thinking they were going to get rich off of all the increase in housing, and then it crashed. And here's the problem. Every time there's a crash, who gets hurt the most? With the 2009 TARP funds, the rich got bailed out. All the big banks got bailed out. What about all the homeowners that lost their shirt and went through foreclosures, had to go through bankruptcies? So huge loss of wealth among the middle and lower classes that got hit the hardest. Every time you have crazy distortions in the market, who gets hurt the most? The middle class and the lower classes, because they're the ones that are least able to afford it. If we had a consistent economy with consistent growth, that's ideal. That's what we want. But half the problem is that everybody wants to kind of goose the numbers to make their presidency look better, or they want the economy to flourish. But instead of doing it the right way and encouraging growth and prosperity for everybody, they want to play funny games. And it really does kind of get me riled up because I see this day in and day out hurting real people. People are struggling. People are losing businesses. All the SBA loans that put out all kinds of this free money. A lot of businesses are closing because the free money period is over. And now reality is setting in. There was a lot of investment, but it was just free money that just, of course, prices went up because the government just threw money out there instead of focusing on actually fixing the problems in our economy. So we're going to switch gears and go to the topic of the day, which is substitute for returns. So what is a substitute for return? Really, it is when you don't file your own tax return, the IRS can come and file for you. Now, when they file for you, do you think they're going to do it in a good way for you? Absolutely not. They file in the worst way possible for you. And we're going to kind of break it down. And how is this done? What to be aware of. So the states do the same thing. They will go in and file for you. The states call it a file enforcement, not an SFR or substitute for return. So when you call and you call the IRS or you check your transcripts, you want to check and see which years are original returns and which years were substitute for return. So if we go back, someone has a tax issue, you're not sure what's going on. When you do your compliance check or you just first call the IRS, you need to ask these questions. And they don't always tell you. So you need to ask, did I file the return? Did you get and receive my return? And there's plenty of times where people filed their returns and the IRS just didn't process them. We see that very often, happens all the time. So if you did file your return, you need to make sure it's received and processed. Most people, they just send it to their taxpayer. They just trust that their taxpayer actually filed it. Until you get either a refund from the IRS or you get some kind of confirmation that it was received and processed, don't trust it. Don't trust that they actually received your return and processed it, because it's possible they didn't. So that's half of what we do, is follow up on everything that we do with the IRS to make sure things are done. I can't tell you how many times we've had people submit returns, they get lost, they submit them incorrectly. So when you are filing returns, make sure they're each in their own separate manila envelope. So if you're submitting 3 years of returns, put each one in its own separate manila envelope. And to save on postage, you can put in one big manila envelope. But if you put 3 returns in one envelope, guess what the IRS does? They might process the top one, and then they'll chuck the other 2. They won't process them. Won't even consider it, because that's the kind of customer service they provide. But you're not going to win that argument. So when you call IRS, you ask, is it original or is it a SFR, filing enforcement? Did I file this return? And if you didn't, this is where you need to get the information to file your own return. So this is where you go back through your wage and income, you get your transcripts, and you get your original information. If you don't have your W-2s, you can even go to, you can the state withholding, usually from the states. You get your income off your wage and income transcripts. And then if it's older than 10 years, the IRS doesn't have that information anymore. You need to go to the Social Security Administration. So this is where filing original returns can save you a lot of money, can really help take care of tax issues. So we're going to talk to, kind of focus on the process here. So the IRS has an organization called ASFR program. So what does the A stand for? Automated. So most of these substitute for returns, or returns the IRS prepares and files for you, it's just a computer program. And so people aren't looking at it. They just look for discrepancies here. They grab this information. And what information are they looking at? W-2s, 1099s, K-1s, any kind of income reported to them, gambling winnings. This isn't just used for audits or underreporting. If you haven't filed at all, they use all this information for just to file substitute for returns for you. Now, if people ask this all the time, where did they get this information? When it comes to the states, they're much more aggressive. They will take, California is one of the worst, and they will assume that you had income based on any licenses you had, any professional careers that you licenses, or if you're a realtor, they will say, okay, well, the average realtor made this. We're going to assume that you had that kind of income and file taxes on you. True story. So, gentleman that called us up, he was furious with the franchise tax board because they had hit his bank account again and he didn't have any taxes. He didn't feel like he owed any taxes. So this is an attorney. He had retired. Now he's living off of his savings. He didn't have any income to report on his tax returns anymore. So he just didn't feel like he had to file. Now the truth here, he didn't have a filing requirement. He had no legal requirement to file his taxes. The lovely state of California went in and said, oh, you were making this much and you just didn't file your taxes. So they assumed that he still had the same amount of income. They prepared the return. They gave him notices. He ignored the notices, or they went to the wrong address, whatever. And then they went out and cleared out his bank account for $10,000. The first year it happened, he kind of shrugged it off. Didn't think much about it. Then they did it again the next year, and that's when he said, hold the phone. I'm not going to have them do this to me every single year. Now it's up to $20,000. We went in, we discovered what was going on, and filed original returns and got him his entire money, all of his money back that they had taken. The problem is, if you wait too long, you might not even get a refund on this. So on older, you have 2 to 3 years to get your money back. If you wait too long, they won't give you a refund. And same with the IRS. Now, if the IRS doesn't a substitute for a return, they go in and they say, okay, well, there's these 1099s, there's these W-2s that aren't reported, and someone didn't file their returns. That's easy for the IRS to go in and file for you. And the interesting part is that they ignore everything that was. So if you have deductions in the past, if you were claiming, if you were married and you had 3 children or something like that, they will always file single and zero. So just you, nobody else, no dependents. They will ignore any mortgage interest deductions that they received and they know about. They're not going to include that either on your tax return that they prepare for you. So they're going to file for you the worst way possible. And this is a tool that they use to try to get people to wake up and go in and file their own return. The states, especially California, even though California is the worst at doing this, but they will piggyback off what the IRS does. And it doesn't always go back the same way. So if the franchise tax board files a substitute for return or filing enforcement based on assumptions of income, that IRS doesn't always pick that up. And in my experience, I don't think they normally do. But when the IRS files on a return and they share information, the states will usually pick that up, and then you not only have a problem with the IRS, but with the states as well. So how do we fight this? How do we know when they're going to do this? So like I said, K1s, W-2s, 1099s, these are easy things. Someone else has reported income. That's easy for them to go after. Now, one of the things that's important here is to understand that they also go after people where they think they'll owe $100,000 and more. So if they have filed for you, and they love to go after self-employed individuals where income has been reported, and they say, okay, well, if we go off this income and we treat it all as cash, then they can hit you with some really hefty penalties and bills. Is it fair? No, I don't think so. But again, this is the problem with letting them file for you. So they love to target self-employed individuals. For example, businesses, you can have $600,000 in net, gross income. So this is everything that's come in. It's very typical to have expenses of $500,000. So there's $100,000 in net profit. That's usually the salary of the owner. Off of that, they would only owe taxes, maybe $20,000 at worst. Probably less than that. So this might be a $10,000, $15,000 case, but now they have to deal with a substitute for return, taxing them on the entire $600,000 in gross income to the business. So this is where it gets really hairy, and they love to target business owners where they know this information is not accurate. They know there's expenses, but if you don't file your return, then they're going to come after you. Can you always file an original return? With the IRS, yes. With most states, yes, but not all states. I've seen states refuse to accept original returns. These are some of the smaller states. California, New York, they're pretty good about accepting original returns. But I have seen some of the smaller states refuse to accept an original return. So be wary out there. Don't just assume that you can go and file an original return and fix it. So when you go and you file an original return, you have to follow up with it. You have to make sure that it's received, it's fully processed, that they back out the original balance. Now, California, it used to be, they've tightened up their rules a little bit. It used to be that once you showed them, hey, I filed the original returns, and they got it, then they would stop collections. They would stop trying to collect the money on those returns, or they would set up an installment agreement based on what you were owing. They've stopped doing that. So you have to get in there and protect yourself from collections, either you yourself or hire a tax professional, while you wait for those original returns to process. And that can easily be 6 to 9 months. anytime you're filing returns that are more than a couple years old, you're not doing them electronically, it's going to take 6 to 9 months with the IRS or with the states. And it can take longer. I've seen some cases where we filed original returns. We had one recently. It took a year and a half. We had to file a 911 form through Taxpayer Advocate to get someone to pay attention to it. We had to hound them for about 9 months. We gave them 9 months to process the original return. They didn't do it. So we filed a 911, filed it with Taxpayer Advocate, hammered on them, stayed on them until Taxpayer Advocate was able to get that pushed through and finally processed, which drastically reduced the tax burden for our client. So again, if you're having issues getting returns prepared and processed, there are avenues, there are people that you can contact to get this through. But when this is a very nasty tool that the IRS uses, is filing enforcements for you and in the worst way possible. And as we mentioned yesterday, talking about expiration dates, if you never file an original return, the balance will run, but they can go and do an examination for you, and there's no hold on that. So you lose rights when you don't file your original return. So we'll be back shortly after this quick break, and I'll see you in a sec. Welcome back, everybody. I'm going to share an article that really does kind of dive in to this process, and this is from Choice Tax Relief. They do have some pretty good articles here through their program. This kind of does a deep dive into their 30-day letter or into the substitute for return process. So first of all, they send a 30-day letter, again, proposed individual income tax assessment. This is just kind of the first notice that, hey, they're thinking about filing a substitute for return for you. This is what it looks like. It will always have the information for the compliance services field director. So again, it has a letter number, letter date, tax form, all of that, and this will be in the heading. So if we go back here, then after 30 days are done, this is your first opportunity to contest it. First ways to contest it is file their actual return. Go file an original return. You can send a statement, say why you don't believe you had a filing requirement, or other information. You were in prison, you were not available, etc. Or this was done fraudulently. Someone reported income under your name. So you can go and file for identity fraud, which again is a bigger problem. We've seen that happen on a regular basis. Or you can appeal the proposed assessment. The easiest thing to do is to just file your actual return. It's hard to do within 30 days. But you can start working on that, get that done. If you have a good professional with you, you can usually get tax. The hardest part is getting the information together. But when you're dealing with older returns, and this is one problem with CPAs, CPAs love to have everything exactly. They want to make sure things are done right, which is a good thing. Unless you're under the gun. Unless you have 30 days or 90 days to respond, and then it can make a lot more sense to just get a tax return in, just get something submitted. Now, this is a notice of deficiency, increase in tax, and your right to challenge. So again, this is just blank information here, but this is important. Notice of deficiency. When you get these, don't ignore them, because then you have 90 days on the return. And it tells you what to do. If you don't agree with the letter, you can send a response form. You can send additional information, but again, file your return. This is going to be your typical response. You have 90 days to file with tax court. So a lot of companies out there, they'll just have you file with tax court just to preserve that right of going to tax court. 99% of the cases do not, it doesn't make sense to go to tax court. And a lot of people go there and clog up, they most cases just get kicked right out of tax court. But if you do have an important issue, you have a disagreement with the IRS, this is important to go ahead and get that filed. And again, if you agree, you can just submit the form and just sign it and say, yeah, I didn't pay taxes on this. But most of the time, it makes sense to file an original return, and this kind of breaks it down: your income, your taxes and credits, how they came up with your tax. So there should be a breakdown on how they came up with that number, and tells you what information that they used to get to that number. It doesn't give you all the information. Then there's penalties, failure to pay. It just kind of goes through the rest of the form. So just be aware here that when you get these letters, don't sit on these. This is where you have the ability to respond. So again, explains how the IRS calculated the taxes and penalties. It gives you your right to challenge in tax court. It starts the clock on the 90 days. So the date on the letter starts the clock to file for tax court and preserve that right if you want to do so. Again, you can still file your original return. And so this kind of gets into it a little bit. There are other people that do prepare returns outside of the automated program. It's not nearly as common, so again, just watch out for that. What do? I like how they put this. Determine if it's in your best interest to file an original return. So if they filed an SFR for you, why wouldn't it be in your best interest? And it does kind of go into this a little bit. Usually it makes sense to file an original return because it almost always lowers your taxability. And it helps when you file an original return, it does not restart the 10-year collection statute. We talked about that yesterday with CSEDs. So if they come in and file an SFR for you saying that you owe $100,000, and then you file an original return saying you owe $30,000, the 10-year CSED or collection statute expiration date doesn't start running. It starts running when they first assess the debt, not when you file your original return. So if you lower the balance, it does not restart that 10-year clock. So here's the difference between the states and the feds. For the federal government, when they do an SFR, it counts as having a return filed for that tax year. But when you're dealing with the states, California especially, it doesn't count for being tax compliant. So that's why it's always important to look at the state and the federal side and make sure that you are dealing with both angles. And this is if they don't have all the information, it could increase your taxpayer's liability. So that's why you always prepare the original return and then look at it, compare it to your what the IRS filed, and see if it's going to actually hurt you or help you. If it's going to hurt you, it doesn't make sense. But with the states, sometimes you're fine, and just with the states, not the IRS, because in this situation, to get compliant and set up a resolution, you still have to file original returns, usually with the states. Ironically here, if you are a good candidate for an offer and compromise, it doesn't make sense usually to file an original return. And there's a couple reasons. They touch on them, and not as aggressive as I would. You're going to do an offer anyway. The offer amount doesn't change. The offer amount is their offer amount. It doesn't matter how much you owe. But when you look at RCP, which I talked about with the realizable collection potential, the more you owe, the more likely it is that you will qualify. And so they touch on this. Reducing the liability could make them a less likely offer and compromise candidate. It can make or break a case. It isn't just can make them less likely. It absolutely can make an offer someone that if you owe more, in many cases, it makes you much more likely to qualify and get that So there's a lot of information here. I thought it was a good article. A lot of this I've talked about. How do you contest it? You file the original return. You pull your transcripts. If you can't get that information from the IRS, and even when you get your IRS transcripts, get that information from the states. Get your tax withholding. And that's one thing the article doesn't talk about is the state side of things. Now, if you're trying to file with the states and it's older than 10 years, you almost never have to do that with the IRS. You have to sometimes go to the Social Security Administration, which can be done. People do it. It's not easy. You have to go stand in line, and half the time they don't know what you're talking about. But you can, and people do regularly, go and get income information for more than 10 years old. So they have that because they keep track of all that for your Social Security benefits. So if for some reason you don't have all their expenses, you don't have the full picture here, when you're filing older returns, and this is going to curl the hair on some CPAs. I had someone call me the other day, and we were discussing this. If they don't have all the data, and part of this, they went through a divorce, and their partner, their ex-spouse, took all the information and is refusing to share it. Can they make conservative estimates of their expenses based on the prior years? In my experience, when you're dealing with much older tax returns, the IRS usually doesn't have a problem with that, or the states. As long as it's reasonable, as long as it makes sense with your industry. Is it possible they'll audit it? Not likely if it's consistent with prior years. And you would be surprised how many times we make the best guess we can when it comes to filing much older tax returns. Sometimes it's just getting it done. It's going to be dirty. It's going to be messy, but we're not going to push the envelope. We're not going to be very aggressive in claiming exemptions and credits, because that's when they're going to question it. But if it's consistent with prior years or a little bit lower, they will usually leave you alone. So that's been my experience dealing with some of these older tax issues. When you have tax returns that you're trying to get this squared away, you're trying to get this figured out. With substitute for returns, the IRS and the states, they will collect on them just like any other return. They can be very aggressive about these, even though when you start talking to, especially California, because they're one of the most aggressive states, about assuming income and just putting it out there. I've seen people in prison where California has filed tax returns for them, and they had to prove that, look, I wasn't working, I was in prison, and actually, submitted the prison dates, their release date from prison and their conviction date, and when they were actually submitted to incarceration, prove that they were in jail, prove that people were sick, that again, and they don't contest it very much, because they know they made up the numbers. So if you provide anything, the IRS, usually the Franchise Tax Board or California and other states, will usually back it up. Some of the most aggressive states, though, where they do not allow for original returns, they will allow for them in the first usually 3 years. After that, sometimes they won't even let you file an original return. So find out the rules where you live. Don't forget about handling the state taxes as well. And make sure that whoever you're working with is taking a comprehensive approach, looking at the IRS and the state issues there, because the states can burn you and be as costly, if more costly, than the IRS. And so do not wait. Do not bide your time thinking that you can get to these kinds of issues. They can be handled, they can be addressed if you get on it quickly, especially with the 30 days and the 90 days. I had one audit or notice of deficiency where this is a case where he was investing in cryptocurrency. It was the guy, he was a plumber. And this talks about, hiding assets. This guy wasn't trying to hide assets, but they see what's going on. and this is actually a couple of years ago, that they already were getting all the information on cryptocurrency. And he had invested about $1,600, and he was trying his hand as a day trader, sold, bought, sold, bought, sold, bought. And over time, he lost the whole amount. And so we figured, there's no income. And this can be very true of gambling issues where there's a lot of substitute for returns. If over time you think, hey, I didn't make that much money, the IRS will get all of the gains reported from every sale, but not cost. They won't consider the costs every time you purchased an asset. So in cryptocurrency, this gentleman had gone in and they came back and said he owed $16,000 and that he made $40,000 in income. We had to go back to the cryptocurrency site that he was using, pull the gains and losses for the year, and we had to prove up to him that, look, he lost it all. And they backed it out, and we wiped out the $16,000 in liability for him. For gambling, this is another big issue where people don't consider that income. All of the wins are reported. And if you don't get your win-loss statements from different, whatever gambling establishments you're frequenting, it's going to be a problem. And so, again, I think this is going to be a bigger problem with people having substitute for returns filed against them, because gambling has proliferated with online gambling of sports. We see it everywhere now. Every advertisement, Caesar's Palace. I mean, it's so easy just to click. But everybody, if you're playing with online gambling, be very mindful to report that, get a statement to report on your tax returns, or you can end up in this situation where they're filing a substitute for return for you. And it's easy for them to do because they get this information recorded. And if you don't get the information of all the wins and the losses to show your true gain or loss, because most people lose money, you're going to be in a tough way when it actually comes to this. So that's my kind of public service announcement for the day. Be aware. There's so many people that have started the online gambling craze. But get that information, report it on your taxes. And if you don't, they will dig this in. They usually are getting this information anyway, and this is going to be easy pickings for them as far as going and filing substitute for returns. Hope you have a great weekend. Didn't mean to scare everybody with this, but get your taxes done, stay on top of it, and have a great weekend.